How do we calculate the estimated tax payment for quarter four, which is due on January 15th? So, this is a great question. Now, first of all, remember this deadline. He's right. January 15th is the deadline to make your estimated quarterly payments. That means whatever income you had last year, you need to make sure that most of those taxes are already paid. By default, the federal government, as well as most states, expect you to pay 90% of your tax liability by January 15th. If you don't pay that, then they bill you an underpayment penalty. Now, for most W-2 employees, that's not a big deal because your employer is calculating your taxes. They're already withholding those taxes from you, and they're paying the IRS or the state on your behalf. So you don't have to worry about it. You're good there. But what happens is not all of our income is W-2. So, for example, maybe you have a 401k withdrawal. Maybe you didn't think about that. Maybe you had a rental income, RSUs, you exercise some stock options perhaps. Maybe you had some capital gains, maybe sold a property or stocks. Maybe you were a heavy investor in Tesla last year, and right in December you banked on it, or you're maybe a big investor in Palantir and made tons of money there, or so many other great companies here in the United States. But anyhow, my point is, the lot of that income that we get is oftentimes we don't really report to IRS until next year, until March or April of 2025. So nobody really knows about how much taxes you owe and whatnot, but IRS still wants you to pay taxes, even though you have not calculated what those taxes looks like. So that's where the problem comes in. People forget this part. People often ignore it because they're not aware of it, and then they get a letter, and then trust me, many times people don't even know what the heck the letter is, and they just pay the penalty. So I'm going to tell you today how you can potentially avoid that penalty, how you should look at this stuff, and how should you calculate all these numbers and do a quick math to take advantage of our system. All right. Those of you guys who are new to the channel, let me remind you guys, my name is Deepak. I'm a tax code advisor. So no matter where you're in the country, or for that matter, if you're living outside the country and you want to do some business in the United States, or you have some income in the United States, you need help in managing your affairs here in the United States. Maybe you have income in another country and you need to make sure you're in compliance in the United States, you can reach out to me from anywhere. Just go to taxcodeadvisors.com and book a free discovery call with me, and then we'll take it from there. All right, now back to estimated tax payments. By default, what do we need to do? What does the government want? The government says, and when I say government, I'm talking about the IRS as well as most states. Different states have different rules, but most of my clients are either from Texas, which doesn't have a state tax, so you guys are good there, or they're from California, and California, California, right? They're big on taxes. They love taxes there. All right. I don't know. Maybe they should have really named California Texas, and Texas should be California, because Texas doesn't love taxes and California does. Anyhow, so how do you calculate this estimated tax payment? By default, we need to pay 90% of our tax liability every year by January 15th. So as long as we do that, we're good. That means if we didn't pay 10% of our total tax liability, IRS is okay with that. California is okay with that. But anything over 90%, they want to bill us extra penalty. They're saying, like, it was your job to figure all this out and pay your taxes, but you didn't, so we are going to bill you. That's what same rule for IRS, same rule for California. But when it comes down to calculating, there are different methods for federal and different methods for California. So for federal, the federal government says that as long as you pay 90% of last year tax liability, we're okay. We're cool. No problem there. But some of you guys are going, well, we don't know what our tax liability is for this year or 2024. I don't know how much I'm going to owe. So how can I figure out that I'm paying 90% of my tax liability or not? That's the problem to begin with. So IRS says, oh, that's a problem. Let me make it easy for you. Why don't you take a look at your previous year tax return, in this case, let's say 2023, and take a look at your income and figure out if you made same amount of money, more than last year or less than last year. If it's the same, you make the same amount of tax payment. You can do that for California, you can do that for federal, you're good. So those of you guys making same income, you're okay. Most of you are probably not in that category. Most of you probably made more income in 2024 than 2023. So IRS says, okay, if you made more money, why don't you take a look at your last year, 2023 return, and pay 110% of whatever you paid in 2023? Meaning you take your 2023 total tax due, and due means like the total tax, net tax that you were supposed to pay after the credits and all that, and then you multiply by 1.1. That will give you 10% over the last year, and that's what you make. You're good, providing you're making more than $150,000, by the way, just to clarify there. But most people are, so not even relevant. Most people are more than 150, so 1.1 of whatever the tax liability for 2023, you're good. What if you made less than 2023? Now that's where comes the problem. Because if you made less, if you make the same amount of tax payment as last year, then you're overpaying in taxes. If you do 110%, you're still paying over in taxes. So if you made less, you really do need to calculate what your tax liability look like, and you want to make sure that you pay at least 90% of that. So that's where the things get a little bit crazy. So I'll give you simple math. If you don't have time to calculate the actual number, easy way to look at this is, okay, what did I make in 2023 and what did I make in 2024? Figure out the difference. Is it negative 10%, negative 20%, negative 30%? And you reduce the tax by the same percentage. So if my income dropped by 30%, maybe I'll pay 30% less in taxes, and that would be the maximum amount I want to make sure that I have paid by January 15th. So you can use that napkin kind of a math to figure out what that tax liability look like. Similarly, those of you guys who do need to calculate for 2024 taxes due, you can do the same math if you even made more income. For example, we can say, well, last year we made $1 million and this year we made $2 million. So we got to pay 100% more in taxes. Now, the one problem that does come is that bigger the income is, the bigger the tax bracket gets. So that's where things kind of get a little bit off. So that's why I'm saying it's a napkin kind of a math. It's not an exact science. So we need to take a look. That upper threshold is what gets a little bit concerning, right? So that's why it's a good idea to really have somebody run a quick calculations to get to that number, to make sure that you're within that 90% bracket, right? Like you want to make sure you pay 90% of your tax liability. But napkin level math is that, let's say if you're 1 million, now it's 2 million, that means I need to pay 100% more in taxes, okay? And as long as I do that, more than likely I will be good. But let me do a quick math here just to kind of show you how these large numbers play. So I did some quick math here. So let's say if somebody had $1 million income in 2023, they would be roughly in about 30% tax bracket for federal tax purposes. That means they're going to pay $300,000 in taxes. Okay, once again, a rough math. Okay, I'm not really calculating any capital gain, net investment tax, or AMT or anything like that. Just a basic math, $300,000 in taxes on $1 million income. Now, if we think about it from a basic math, if this person has $2 million income now, that means my taxes would be double, right? 100% more. So you would think that I can pay $600,000 in taxes. The problem is the higher, once you go over that $500,000 mark, your tax brackets start to go bigger, and you are paying extra tax on that higher income. So for example, if you're on $2 million, your tax bracket will, and I'm talking about your effective tax rate, by the way, because remember we are in a progressive tax system here. So it goes from 30% to about 34%. So we are paying almost 3.5-4% more on that income than before. That's averaging everything else altogether. So on a $2 million, my calculation shows that tax would be almost $670,000. not 600,000. So that's what I'm saying. You have to be very careful with this number here to keep track of that. So the higher the income is, maybe you want to keep in mind and maybe add additional 3%, 4% just to make sure you're good there. Okay. And now let's just say, for example, just for the sake of benefit here, let's do a $3 million calculation. See how does that look like? Okay, so on a $3 million income now, your tax bracket has gone up by another 1.5%. So you're close to about 35% now. And I'm just talking about federal, not including state. You're at 35%. That means overall, you would, so with the original math, on $1 million, our tax liability was 300,000. So you might make a guess and say, okay, on a 3 million, that would be 900,000, right? So you have to be a little bit careful with that, because that additional 2 million now is in a higher tax bracket. So the actual taxes on $3 million income will be almost $1,040,000, not 900,000. So now you're off by $140,000. So obviously that is going to get you in a little bit of trouble there. Remember, so be careful with that. But remember, the safe harbor rule is a little bit different. The safe harbor rule says, look, as long as you make 110% of last year, we are okay, right? So you don't have to worry about all that. But that's only for federal purposes. But what about the state? State still wants 90%. And if some of this income is not ordinary income, for example, maybe it's a capital gain, sometimes you might miss out on those net investment tax. That can be really painful. So just be careful on that as well. So the point is, it's a good idea to keep all those things in mind. Maybe at least send a tax professional what is the total ordinary income and how much of it is capital gain taxes, and let them give you a ballpark figure. Because remember, they don't have to be 100% accurate. As long as they get into that 90 percentile percentage, you will be okay. So if the income is lower, and when I say lower, let's say less than $700,000, $800,000, then you can use this rough napkin math by just coming up with percentages. But if your income is more than that, especially if it's over $1 million, then you need to understand that there's a slight increase in your effective tax rate, because that higher income is taxed at a higher level, and that can throw you off a little bit, especially from a state point of view. From federal, you're good because we can still use last year and use safe harbor. But from a state, we do need to get into that. More than 90% of tax liability. So just be careful with that. I hope I didn't make it any more confusing than it has to, but at least you can use this math to figure out if you have paid enough tax liability for the year or not. Or better yet, forget the 90% rule, right? Think about paying 100% of tax liability by January 15th. Okay, now I know some of you guys are tax savvy and financial guys and like, Deepak, why are you telling me to make extra $100,000 tax payment? I can earn some interest on it. I can invest in stock market. Okay, I get you. I'm with you. I'm not trying to force you that way. I'm just saying, for the purpose of calculation, if you forget, because when we think about 90%, I think that 10% grace that the states and federal giving us is, so if we have a mistake in our calculation, that will account for it. But if we start by thinking about 90%, then the math goes a little bit wrong, right? That's why I tell all my clients that, don't forget the 90%. Let's just stick with the 100% math. That way, if we are wrong, we're still okay. Now, you can always do real calculations, but who has time to do that, honestly speaking, right? Everybody's busy. We want to do a quick math, and this is how you can do it. Less income, use the percentage method. If it's more than that, I would just say add maybe 3-4% on top of it. And that will make sure that you're getting to that number, because the higher the income, the higher the percentage. Very simple math, okay? So I hope you find it helpful. If you still have a question, you need some help with filing your taxes, you need help with figuring out how to run these calculations, put it in the comments, reach out to me, set up an appointment, and then we'll take it from there. Thank you so much for spending your last 15 minutes with me. If you have a tax question, don't hesitate to reach out to me. Talk to you soon.